Economy update relative to GDP report today and the news of the personal consumption expenditures, or PCE, inflation. And then also discussion of Trump's tariffs being set back by the Supreme Court here. I'm Rich Pasa for Critical Point, and it's Friday, February 20th, 10:59 a.m. Eastern Time. So this is a chart of the personal consumption expenditures, or PCE, inflation. We had the recession in 2020 and a juggler business cycle, down move and bottom, end of recession. Snaps up to the kitchen business cycle. That's typical behavior after a recession. Some people might want to call that a juggler, but that would mean they would be forecasting the next juggler top after the next recession. I don't do it that way. You can do it, but I don't think it's useful information. The real juggler was just ahead of the recession. It occurred in 2019, if not 2018, by some data. Okay, the juggler is a decade-long business cycle that relates to 7 to 12 years of economic boom and 1 to 3 years recession, contraction, bust, and maybe as little as 6 months. And COVID gave us a new statistic of just 2 months, but we'll leave that as extremely rare and question if we see it again. Now, the juggler breaks into 4, 5, 6 kitchen business cycles. And then it was discovered by Mr. Kitchen, and it's about 3 to 4 years, when Kitchen said it was probably a little more than 4 years, but I've learned how to make it more accurate. The kitchen business cycle causes fluctuations up and down of business data, statistics, the economy, and the stock markets, or any markets, inside of this juggler business cycle. Okay, it's a throttle up, throttle down process. So it goes up into a kitchen, comes down into a kitchen bottom, barely picks its head up for inflation into a kitchen top, came down to help prove that top, could not, it tried to move higher, couldn't do it, couldn't break it out, eventually gave up, and it's moving lower. Now, we can find a level 1 top, a level 1 bottom, and then a level 2 top that's less important, and that's drifting lower. And this is by the end of the year of last year, the fourth quarter, okay? What it suggests is there's a chance inflation could stay down for a few months, but it really ought to be putting in a bottom soon, another kitchen bottom, and move up later this year. And I've been forecasting that for many months, that we could see higher inflation later this year. However, I'm getting concerned we're pretty much over the chance for these tariffs to really work through and create a surge of inflation. I think it's going to have to be something else. And it may have to wait till 28, 29, 2030 as we come into peak economy and the end of that juggler before the next recession. And it may not be all that big a deal. Anyways, I'm personally going to start bowing out of the importance of worrying over inflation, and perhaps for the rest of this decade. But it's still in the model. We'll still discuss it more than normal, but a little less. I think there's a chance we can see rather soft inflation here for a while, pick it up, but it's not going to be all that big of an up move. And looking out to 27, 28, it may be down. And in 27, I'm still looking for some inflation, or some economic problems that may actually help bring inflation down anyways. Okay, so let's talk about the GDP that came out this morning, and it was 1.4%, well below people's estimates of 2.5 to 2.8%. So a little shocking move there. And what the model's suggesting is that was for the fourth quarter of last year. The first quarter of this year, we're probably going to see an improvement in GDP. And I think some of the economic data in the last couple of weeks here kind of supports that idea. And I think we can see improvement this year and the next. But the modeling's not forecasting a great economy, okay? We're just going to improve somewhat, and we'll take it from there. And some of this modeling is pointing to problems down the road. So we have that chart, and next we want to take a look at, this is another chart of, actually it's out of scale here. That was more of the inflation. So now I want to switch back to more GDP. Now, this is federal debt, total public debt as percent of gross domestic product. And you can see in COVID, we slammed it up and then we brought it back down. It's still kind of some kind of uptrend like that. It's starting to tick back up a little. It is at elevated levels and a concern. We might have a little too much debt in business. It's forecasting, along with many things, a day of reckoning's coming, that we're going to have another recession. But the problem is, That doesn't have to show up to 2029, 30, 31. It may show up next year, so we have to watch out for next year. But in general, there's probably a few years yet before some of this debt's a problem. Now, if you look at public debt, the government debt looks similar to this chart, and yes, it's elevated, but my modeling doesn't pay much attention to it because government debt isn't real debt. It's a different kind of debt because we owe it to ourselves. That's not going to wreck the country, okay, because the government can print all the money it wants to, as long as it doesn't create too much inflation. Okay, so it's the public debt, private debt we have to worry about. And today we got private credit news, or this week, of some problems and complications, and some banks are buying out some of those non-banks and private credit. I wonder, is the Federal Reserve kind of telling them to do that, or is it just an opportunity for them to expand their banking business? But it feels like somebody's trying to make that problem go away. And the Federal Reserve recently pumped $18 billion into the banking system. So we do have to watch out for that private credit. That could be a problem this year into next. Maybe somehow we kick the can down the road, but I don't doubt by the end of this decade we're going to have another credit issue, debt issue, as part of a business consumer recession, economic problem, and a bear market in the stock market. But right today, looks like we might get a little relief here to make some improvement in the stock market and economy. Now, this chart is the real gross domestic product month to month, or actually quarter to quarter, and it does help back up the saying of 1.4% down, but there's other GDP measurements, doesn't show that big of a move. They're just different numbers, same fluctuation, and all I can tell you is looks normal fluctuation to me right at the moment here. And then this is the analysis from the business cycle model on GDP, what we're forecasting for the economy relative to GDP. What we have is a jugular business cycle top, bring it down to the jugular business cycle bottom, had the COVID recession, slam it up to a kitchen business cycle top, bring it down to a bottom, up to a top, and now it's trending lower. And ideally, the GDP should bottom at the end of 2025. 2026 should be an up year for GDP, but it ought to stop going up in 2026. It could be lower in 2027, giving us an economic problem in 2027. Or I should say it'll be reflecting an economic problem in 2027. But at the moment, it looks like GDP would recover. Now, we need GDP to recover more than what it was back here in the fall months, which I didn't write that number down. We need to get it probably above the 2.5%, and that would help give us a clue. We probably put in a kitchen business cycle bottom. I will allow for a little spillover into the first quarter of this year of a little weak GDP, but it really shouldn't. If we have GDP for the first quarter less than 1.4%, that's probably a warning of problems for quite some time for the economy. Even though it can recover, it would just be warning something's going to blow up on us, okay? Otherwise, we want a GDP better than 1.4%. Now, if it takes out 3.4%, which I believe that's that high there, and this high would be another clue, as long as we're not due for an important business cycle top, then I would assume there'll be still better GDP than that, okay? And that would give us all the evidence we need. It's in another mood. Now, these kitchen cycles, you can sometimes put 2 or 3 of them together that creates a Benner cycle, and that's this B with the question mark. If that's a Benner cycle and it would just be the minimum time for it, things could have improved better still going into 2029 to 2030. But I'm still looking out for something that might break earlier than normal, that 2027 could still be a recession, and that decade-long business cycle would be as short as what was under George W. Bush going into the financial crisis. And you go back in the 1800s, there's a few more of those. A little less than 20% of the time, this business cycle modeling of the jugular business cycle didn't really work the way it was supposed to. It broke, and the Benner cycle inside of it broke, and the kitchen cycle inside of that, or inside of the jugular, depending how you want to look at it, also broke, and it would made it very, very difficult to predict. It's low probability, less than 20%, but the point is, under Trump, it could happen this time better than under anybody else. So we have to look out. 2027 could be a recession, stock market down 35, 60%, all kinds of crazy things. But that's low probability right now. It's just something to watch out for. More likely we will get a slump in the stock market and economy in 27 take it still higher towards 29.30, then we'll get the once a decade sell signal for the stock market. We'll get the normal recession, and hopefully it won't be so severe because we moved beyond Trump and some of these crazy things that are going on right now. So the best forecast is, I think the first quarter of this year will be better than 1.4% GDP. I think it could pick its head up this year. Later this year, I think inflation could pick its head up, but I'm no longer concerned about that. I can wait on that and just try to keep up with it. But in 2027, we still want to look for at least a little bit of a slump in the economy and the stock market, and quite possibly something far more serious than that. So stay tuned. Go to criticalpointpod.com and get on board. Past results not necessarily future results. Thank you.